Anthropic $36 billion debt risk. Is the hidden threat exposed? Anthropic's $36 billion debt risk compels you to secure your AI investment strategy and protect infrastructure value. The proposed $36 billion Blackstone private credit package shows you that AI infrastructure financing is accelerating beyond traditional venture capital, making capital discipline increasingly important as investment cycles approach historic proportions. When you combine the proposed $36 billion package with the earlier $35 billion transaction, nearly $71 billion has already been structured around one AI customer, exposing unprecedented financing concentration. You should notice AI computing is no longer funded like conventional software because processors are increasingly financed like aircraft, power plants, and telecom assets requiring decades of disciplined infrastructure investment. Instead of purchasing billions in chips outright, special-purpose vehicles acquire Google's TPUs and lease them back through long-term agreements, shifting ownership while creating fresh financing and refinancing obligations. L-Impact Solutions argues you should never celebrate $71 billion of financing alone because leverage expanding faster than sustainable enterprise cash flow has historically created painful corrections across multiple industries. You should question whether rapidly expanding AI debt resembles previous infrastructure booms, because history shows excessive leverage repeatedly amplified losses during the 2000 dot-com crash and the 2008 financial crisis. The article suggests global AI infrastructure spending now exceeds traditional venture capital capacity, forcing private credit, structured finance, asset-backed lending, and infrastructure investors to fill an enormous funding gap. Rather than carrying tens of billions in hardware, companies increasingly lease compute assets, improving balance sheet flexibility while introducing long-term contractual obligations that investors cannot afford to underestimate. You should recognize Broadcom's residual value support strengthens investor confidence today, but no financial engineering permanently eliminates technology obsolescence, utilization uncertainty, or refinancing pressure over future market cycles. AI processors improve dramatically every 3 to 5 years, meaning today's premium infrastructure could depreciate far faster than airports, pipelines, aircraft, or traditional industrial assets with decades-long operating lives. You cannot ignore concentration risk when investors simultaneously depend on a handful of hyperscalers, semiconductor suppliers, cloud providers, electricity producers, and frontier AI laboratories supporting global infrastructure expansion. The article correctly warns that investors now face technology obsolescence, lease performance, AI adoption uncertainty, electricity constraints, semiconductor depreciation, regulatory changes, and shifting competitive dynamics simultaneously. L-Impact Solutions believes Google's expanding AI financing ecosystem, approaching $200 billion reflects extraordinary capital availability. But you should evaluate governance quality before admiring financing scale alone. The projected $769 billion hyperscaler AI infrastructure spending during 2026 signals remarkable ambition. Yet every additional dollar invested should demonstrate measurable operating improvements before further capital commitments are approved. Long-term AI infrastructure commitments exceeding $5 trillion through 2030 highlight unprecedented expansion. But history repeatedly proves capital intensity alone has never guaranteed durable shareholder value or competitive leadership. You should worry whenever financing duration exceeds asset usefulness, because processors may remain commercially competitive for only 3 to 5 years, while debt obligations often extend considerably longer. JP Morgan estimates AI-related issuance could eventually represent 25% of the U.S. investment-grade corporate bond market, compared with roughly 5% today, illustrating how dramatically financial markets are evolving. The article emphasizes structured leases, vendor guarantees, and residual value agreements improve financing efficiency, yet they cannot permanently shield you from weaker AI monetization or declining infrastructure utilization. Loan yields approaching 9% on certain AI infrastructure transactions indicate institutional investors increasingly demand stronger compensation because perceived financing risks continue rising alongside infrastructure commitments. Aggregate free cash flow across major hyperscalers is projected to decline as AI capital expenditure accelerates, reminding you that impressive investment announcements can simultaneously weaken financial flexibility. AI-related debt issuance reaching approximately $236 billion through May 2026 demonstrates debt markets are rapidly becoming essential funding engines for AI expansion rather than supplementary financing sources. L-Impact Solutions challenges organizations prioritizing compute acquisition because governance, cybersecurity, regulatory readiness, workforce capability, and measurable return on invested capital often receive significantly less strategic attention. You should never approve multi-billion-dollar AI infrastructure spending until every investment exceeds predefined hurdle rates, delivers positive economic value added, and demonstrates measurable productivity or revenue improvements. Boards should demand scenario testing across at least 5 financial conditions, including optimistic demand, baseline utilization, slower adoption, elevated financing costs, and accelerated hardware depreciation before releasing additional capital. You should insist management quantify projected IRR, DSCR, utilization thresholds, electricity price sensitivity, and refinancing requirements because disciplined measurement consistently outperforms optimistic forecasting during volatile capital cycles. The recommendation limiting dependence on any single hyperscaler, semiconductor architecture, lender, geography, or electricity supplier to 30% to 40% provides a practical framework for reducing concentration risk. You should continuously monitor compute utilization above 80%, infrastructure availability above 99.9%, data quality above 98%, and cybersecurity compliance approaching 100% to maximize infrastructure value creation. Financial resilience requires diversified funding, staggered debt maturities over 5 to 10 years, liquidity covering at least 12 months, and leverage capable of surviving temporary reductions in compute demand. L-Impact Solutions recommends evaluating AI processors annually for performance per watt improvements, resale opportunities, redeployment potential, maintenance economics, and replacement timing because infrastructure efficiency continuously evolves. You should remember that owning the largest compute cluster matters far less than consistently transforming AI infrastructure into recurring revenue, stronger cash flow, resilient balance sheets, and sustainable long-term enterprise value. You should negotiate vendor performance guarantees, residual value protection, diversified lease structures, energy supply contracts, cybersecurity insurance, and robust service-level agreements because every safeguard reduces long-term financial volatility. Governance must evolve alongside capital deployment because independent AI investment committees should evaluate every major infrastructure decision using standardized financial metrics, operational KPIs, compliance indicators, and quarterly performance reviews. The article argues future AI investment should resemble regulated infrastructure portfolios, reminding you that disciplined governance historically outperforms unchecked expansion when capital commitments become exceptionally large. You should release capital in stages instead of approving 100% funding upfront because independently verified utilization, profitability, customer adoption, and operational milestones significantly reduce stranded infrastructure risk. Technology concentration deserves continuous board oversight because excessive dependence on one cloud provider, AI model, semiconductor supplier, lender, or power source can quickly amplify enterprise-wide operational disruption. L-Impact Solutions advises you to treat concentration risk as a measurable enterprise KPI because diversified technology ecosystems consistently deliver stronger resilience than highly centralized infrastructure strategies during market disruptions. Organizations should conduct annual macroeconomic stress tests covering at least 10 major variables, ensuring higher interest rates, weaker AI demand, cyber attacks, trade restrictions, and refinancing shocks receive quantified contingency planning. You should never assume electricity will remain abundant because global electricity demand is projected to rise more than 50% within the next 5 years, fundamentally reshaping infrastructure planning priorities. The article also highlights that U.S. electricity demand alone could increase approximately 40% during the next decade, making reliable energy procurement a decisive competitive advantage rather than a routine utility decision. Long-term power contracts, renewable integration, diversified grids, and resilient procurement strategies should become strategic priorities because AI infrastructure cannot deliver value without dependable electricity, supporting continuous compute availability. Regulatory readiness should become an ongoing discipline because AI accountability, privacy, cybersecurity, intellectual property, explainability, and cross-border data governance continue evolving faster than many organizations currently anticipate. You should demand annual external audits and measurable compliance KPIs because regulatory failures often destroy shareholder confidence far more quickly than temporary technology or market setbacks. Quarterly reporting should disclose AI capital expenditure, utilization, operating efficiency, cybersecurity posture, energy consumption, governance maturity, and return on invested capital, allowing investors to evaluate sustainable long-term performance. You should distinguish productive AI investment from simple infrastructure accumulation because history repeatedly proves assets without measurable business outcomes eventually become expensive financial liabilities instead of competitive advantages. The article concludes organizations transforming AI infrastructure into recurring revenue, stronger cash flow, resilient balance sheets, and sustainable shareholder value will consistently outperform competitors focused primarily on compute scale. You should recognize the proposed $36 billion financing represents more than another private credit transaction because it signals financial markets increasingly treating AI compute as an investable infrastructure asset class. Combined financing of approximately $71 billion, Google's ecosystem nearing $200 billion, projected $769 billion spending in 2026, and $5 trillion through 2030 collectively redefine global capital allocation priorities. You should remember that bigger financing packages never guarantee stronger businesses because disciplined capital allocation consistently outperforms aggressive borrowing across virtually every major economic cycle over recent decades. L-Impact Solutions emphasizes maintaining compute utilization above 80%, resilient liquidity, diversified infrastructure portfolios, transparent reporting, and measurable returns because operational excellence ultimately determines long-term enterprise competitiveness. The article challenges you to treat AI compute as a productive financial asset rather than an unlimited operating expense because sustainable capital efficiency increasingly separates durable winners from speculative participants. You should ask yourself whether your organization is measuring infrastructure success through revenue growth and cash flow, or simply celebrating larger hardware deployments that may never generate proportional economic value. Every major investment deserves measurable productivity gains because capital markets have historically rewarded businesses producing durable returns instead of those merely announcing increasingly ambitious spending commitments. You should challenge every AI expansion plan by questioning utilization assumptions, refinancing exposure, technology life cycles, electricity resilience, and governance maturity before approving another billion-dollar infrastructure commitment. The critique reminds you that financial engineering may improve funding efficiency, yet sustainable competitive advantage still depends on execution quality, disciplined leadership, and consistent business monetization rather than sophisticated deal structures. You should view refinancing risk with greater skepticism because rapidly depreciating processors, combined with longer debt maturities, create structural vulnerabilities rarely experienced within conventional infrastructure financing markets. AI infrastructure investment is steadily transforming into a capital efficiency competition where governance, liquidity, utilization, resilience, and measurable returns increasingly outweigh raw processing capacity or headline financing announcements. L-Impact Solutions ultimately argues your strongest competitive advantage will emerge from disciplined investment governance, not from chasing the industry's largest debt package or fastest infrastructure expansion alone. You should evaluate every financing decision against long-term shareholder value because borrowing billions without predictable monetization has repeatedly undermined ambitious technology leaders throughout financial history. The broader message encourages you to prioritize resilience over excitement, recognizing that transparent governance, diversified funding, and operational discipline consistently outperform aggressive expansion during uncertain macroeconomic environments. Ultimately, you should remember the AI economy is evolving from a technology race into a capital efficiency race where disciplined governance, sustainable cash flows, and responsible financing determine tomorrow's enduring market leaders. Will your AI strategy create enterprise value or become your next $36 billion debt trap? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.